A very important part of the interest rate that is assigned to a particular borrower, be it private or corporate, is his or her default risk. Considering the components that form interest rates, the default risk is the only ingredient which is unique for each and every single case. The other four components are common for most loans or are attributable to a large category. They are more or less standard. Everyone starts from the same level of LIBOR and faces the same risk of inflation. The default risk is different. It is specific for every borrower. Every person, every corporation, or even every country carry their own default risk. And given that it is the only component that is strongly individual, this is where the bank concentrates when it tries to determine how much to charge you. The bank wants to assess A, how much it is going to lose if you default, and B, how likely it is that you will default. Let's go a step further and introduce the following equation. EL equals EAD multiplied by PD multiplied by LGD. What we have here is expected loss equals exposure at default multiplied by the probability of default, which in turn is multiplied by loss given default. The first term, EAD, exposure at default, shows what the amount is that the bank will risk if we default. These are usually the funds that it lent to us and we still owe. The probability of default stands for the likelihood that the borrower will default. And then the loss given default expresses what percentage of the bank's exposure will actually be lost. It is very rare that a bank loses its entire exposure. A practical example might help. Let's imagine that an individual buys a $300,000 house and finances the acquisition through a bank loan. The bank lends him or her $300,000 and he or she buys the house. After granting the loan, how much is the bank's exposure at default, EAD? Yes, it's $300,000. We are assuming that the person hasn't made any payments. The probability of default is the likelihood that the individual would be unable to cover the payments of the loan. The higher the probability of default is, the greater the interest rate that will be applied to the loan. It depends on a series of factors that we will cover in a minute. The third component of the equation is loss given default. That is the portion of a bank's funds that will be lost if a default occurs. Banks never lose the entire exposure because normally they require guarantees from the borrower. For example, banks rarely lose more than 30% on mortgage loans because they have the right to resell the real estate property in order to get their money back. This is not necessarily true during difficult market conditions, but despite that, we can conclude that the more guarantees that are given to a bank under the form of mortgages, assets, pledge on shares, future incomes, etc., the lower the expected loss percentage will be, and hence the interest rates they will charge you. And alternatively, if the bank has few or no guarantees, the interest rate for it will be much higher. Several factors influence the estimation of the borrower's probability of default. For example, earning potentials, liquidity, past behaviors, quality of assets, and external factors. Let's go back to our case. The person who wants to purchase the house needs $300,000 in order to do so. The first thing that will be assessed by the bank is earning potential. The bank needs to determine whether he or she will be able to earn enough money that would allow him or her to pay for the mortgage and cover living expenses. The larger the amount that remains after paying the mortgage, the better it is, because this provides extra security to the bank. If the mortgage is for $300,000, the borrower will need to pay $2,500 a month throughout the next 10 years, or $1,250 a month in 20 years. On top of that, he or she will be charged interest, which means that he or she will need to earn significantly more in order to pay the mortgage payments and have sufficient funds remaining in order to cover living expenses. Liquidity is important. A person may be rich in terms of total value of assets owned, but that same person may end up in trouble if he or she is unable to convert those assets to cash. Imagine that in our example, the person who wants to acquire the $300,000 house is paid on a project or per project basis. What if the payment of the next project is delayed by 3 months? He or she will miss 3 mortgage payments and will incur further debt in order to cover living expenses. This is why liquidity is important. It gives the borrower a cushion in case something does not go as planned. A borrower with a record of paying debts on time and having a long-term home address should be offered a lower rate of interest than someone who has missed payments or was unable to pay loans in the past. So in our example, if the person applying for a mortgage loan has good credit history and has been a good faith borrower in the past, then it's much more likely that he or she will be granted a loan and that the loan will have a lower interest rate. Finally, we will consider the so-called external factors, such as industry development and market risk. These do not depend on the borrower, but are related to his ability to repay his loan. If, for instance, he operates in an industry that is cyclical, this represents an additional risk that is accounted for in the interest rate that will be attributed to the borrower. These are the components that influence the assessment of the borrower's probability of default. Once the bank determines its expected loss from the equation that we saw, it will know how much to charge in terms of the interest rate.